Hey everyone, what's up and welcome to Front Run, where we predict the future of money and technology. Thank you to all of the new listeners, subscribers, and followers. Tons of traction over the past couple of weeks. Pleasantly surprised and greatly appreciated. If this is your first time with us, we are all here to front run what we believe is the next generation of wealth creation, decentralized finance, and crypto. I'm your host, John Cook. It is the second week of February 2023, Super Bowl weekend for those in the States. And we have an interesting topic that we're going to cover today. I wrote a lot about this on frontrunCrypto.com. I think it's one of my longer writing pieces. I clocked it at 17 minutes. It probably took maybe 5 or 10 hours to write. I'm not really sure. But it's important. It's important because today we are going to answer the question, what's causing crypto prices to go up, right? There's a lot of narratives and talking points and ideas and thought pieces that permeate across Reddit and crypto Twitter about why this price action that we're experiencing in the crypto ecosystem is somehow different this time. I mean, why are crypto prices going up? Why is Bitcoin up 35% year to date 2023? Why is Ethereum up 30% year to date 2023? Why is optimism up 150% year to date 2023? Is it because we're in this new perma bull run era where we've transcended a new set of fundamentals, or we have new user adoption, or we have product market fit that we didn't have before? Or is it the Federal Reserve acting as the invisible hand of the crypto economy by controlling interest rates and, as a byproduct, the spending habits and general sentiment of the broader investing community? Or is this just another dead cat bounce where we'll see a little pop and then it will drop down and all the gains we've realized over the past 30 days will be gone? So we are going to answer that question today. I encourage everyone to go to frontruncrypto.com, hit the subscribe button there. It's free. And it's actually the center point of Front Run Out Loud, which is the podcast you can see right now. Every week, I publish 2 thought pieces on the crypto market. Usually one piece is my point of view about the market or some event that's taking place. And then the other article is usually some like technical piece, like how some protocol or DApp works or something along those lines. Like, for example, last week I wrote about Grayscale's misconduct and conflicts of interest with Digital Currency Group, and I also wrote about Sentiment's under collateralized lending platform on Arbitrum. Right, 2 very different topics. So good compare and contrast. So if you haven't already, go to frontruncrypto.com, frontruncrypto.com, frontruncrypto.com. It's free. Cool. Now let's dive into it. What's causing crypto prices to go up? And for those watching on the YouTube, I'm going to walk through the article that explains my point of view on why crypto prices are going up. For those listening in podcast land, I'll just talk to the charts as they come up. But what I've seen floating across like crypto Twitter, Reddit, and like a lot of the talking heads that I follow on Substack is this super bullish narrative that we didn't have in 2022, at least not in the fourth quarter. Quoting some of the more prominent players, quote, Bitcoin Magazine Pro 127.23. On-chain cyclical indicators are currently pointing to a classic bottom, right? Bankless 123.23. This rally is different. Coin Metrics 191. The digital asset market has seen a remarkable rebound, right? So everybody we follow, everybody who talks about crypto, all the experts in crypto are saying, oh gosh, this rally's different. Now is the time to buy. And I mean, technically through the end of January 2023, they were right. Year to date 2023 through the end of January, chances are you probably read an article or a tweet or been on some Reddit thread that has said this time it's different. We are on the cusp of generational wealth. We'll never see ETH below $1,000 in our lifetime. Why not celebrate? I mean, I pulled up. I've pulled up it's called Coin Metrics CMBI Total Market Series Sector Index January 2023. They basically take hundreds of crypto tokens, aggregate them into various sector indexes like metaverse, smart contract platform, IT, decentralized finance, blockchain utilities, specialized coins, etc., and then they track the performance of that index in the aggregate. And what they found, like through January 2023, every index is on a rip. Every index, it's all up and to the right. The the median return on the CMBI Total Market Index for January 2023 year to date is 40%. 40%. That means if you invested $1 in crypto in any one of these indexes in January 1st or January 2nd, 2023, it would be worth $1.40 today. If you invested in like the metaverse group of funds, it would be worth more, like 59%. That's $1.60 today for every dollar invested. I was looking at what is it? Mana? Mana is the crypto token for Decentraland. It's up 111% year to date. Granted, it was down 90% in 2022, but setting that aside, every token has been up and to the right, and the CMBI Total Market Index series through January 2023 like reaffirms its position. So if maybe the pundits are right, maybe the social media experts, the individuals, the talking heads we look to for guidance are right. Maybe this time it is different, right? Let's keep going, right? And I'm gonna walk you through why. I'm gonna walk you through the most common topics that crypto experts and social media influencers usually point to when justifying the upward momentum that we've experienced over the past, at least through January 2023. So these are the talking points that people say when they're trying to explain why crypto prices have been up and to the right in the month of January, right? So if you look at my screen, it's a big green set of boxes. It's all like positive returns. Here are the reasons why. And chances are you've heard some form or fashion of this. So the first theme is it's usually something along the lines of like softening macroeconomic headwinds. Softening macroeconomic headwinds. Like, what does that even mean? Like in plain English, right? It's crazy how many like crypto people became like economists in 2022. It's really just a fancy way of saying that the market believes that the Federal Reserve, this is Jerome Powell, is comfortable accepting that inflation has eased. More specifically, the market, via the words and the actions of the Federal Reserve, which is really Jerome Powell, all collectively believe that the worst is behind us. And the worst means inflation. Remember in 2022, like core CPI was like 8% year over year, right? Inflation's still pretty bad. Eggs are expensive, chicken's expensive, so on and so forth. But the rate of inflation is going down and it's decelerating. So if you look at year over year, like, I don't know, April, May 2022, core inflation 8%. What we see now is like core inflation 5 or 6%. So the impact of that is the federal funds rate, which is a throttle that the Federal Reserve uses to control interest rates. Basically, they raise it. It makes everything more expensive. That reduces spending. When people spend less, the cost of goods go down, inflation goes down, and that's what lowers inflation, right? So if you imagine that the Federal Reserve and Jerome Powell have like this sledgehammer and they can hammer the economy with it to decrease inflation by making everything expensive, that is the federal funds rate. Federal funds rate in 2021 was 0%. Now it's like upper bound is 4.5%. This is like the fastest growth that we've experienced in like modern history. But now the market says, hey, that's all behind us. We're increasing at a slower, more predictable rate. And eventually, Jerome Powell and all the economists and talking heads will see inflation normalize at a steady state of 2 or 3%. And when that happens, the money printer is going to get turned back on. We're going to be on a rip, right? So how do they know this is true? How do economists know that the U.S. Federal Reserve is comfortable accepting that inflation is eased? Like, how do they know that? Like, Jerome Powell's never said that, right? So they look at charts and they quantify, like, it's called like crossover metrics. And I've written about this in the past with respect to like short-term treasury yields offering higher short-term treasury notes offering a higher yield than the long-term counterpart, and when that happens, that's the flight to safety, and that inversion means like a recession, right? So economists take this data and they create something called a 2-year treasury yield and federal funds rate target rate inversion, and that's what I have displayed right now. There's two charts. Chart number one, x-axis is time, y-axis is the U.S. government 2-year treasury yield. That's the black line, and the blue line is the federal funds rate target rate upper bound. And what economists point to when like trying to quantify or predict whether inflation has eased or will ease is they look at the crossover of these two metrics, specifically when the 2-year treasury yield crosses below the upper bound of the federal funds rate. What usually happens are periods of growth. And I pulled up a chart from LPL Research that outlines this. LPL Research, these guys are amazing. You should subscribe to them. All their content's free. I don't know why. I would pay for it. It's so good. LPL Research, like, looked at the performance of the U.S. stock market, specifically the S&P 500, after the 2-year treasury yield crosses below the Fed funds target range upper bound. Okay. So when the treasury yield crosses below the Fed funds rate target upper bound, what happens to the S&P 500 1 month, 3 months, 6 months, and 12 months after, right? Historically, 80% of the time, performance has been positive. The median return on the S&P 500 12 months after this crossover is 22%. 22%. That's going to be huge for like crypto assets because they really run as like a high beta tech stock. But based on this historical data, economists and really like financial institutions say, hey, the 2-year treasury yield, it's crossed below the upper bound of the Fed's funds rate. This is an indicator that markets are improving and the worst is behind us. And look at the historical performance of the S&P 500 after this event occurs. It's gangbusters, right? So that is reason number one why people think, why many crypto enthusiasts, crypto Twitter and Reddit think that crypto prices have been going up in 2023 is because of the softening macroeconomic headwinds via the U.S. Federal Reserve. But, is this really like an explanation? Or is this another random walk led by economists attempting to explain the most recent round of rational exuberance? I'm a huge fan of the book Rational Exuberance. Everybody should read it. There's a link in the show notes. So, point number one, macroeconomic headwinds softening. Jerome Powell is easing up. All right, point number two. Why are crypto prices going up in 2023? Okay, another popular theme is the deleveraging within the DeFi ecosystem. Okay, so we saw this in TradFi, GME, Bed Bath & Beyond. It's no different in the crypto ecosystem, and it's caught a lot of attention. So let's look at the data and be careful in understanding whether it's fact or fiction. Okay, so deleverage within the DeFi ecosystem. Like, what does that actually mean? All right, so there is a theme in DeFi that leverage drives price action, okay? And when I say the words drives price action, what we mean is a squeeze. You probably heard the term short squeeze, or maybe even like a long liquidation. That is what drives price action. That is the leverage driving price action. So I have an example. We'll walk through it together. Let's say you're bullish on ETH. Okay, you think ETH's gonna go to the moon in 2023. So you want to take advantage of this belief that ETH's gonna be a killer this year. So you go leverage long on it. Okay, leverage long means you go to platforms like GMX if you want no KYC, or KuCoin or Binance if you want to do KYC, and you buy a futures contract that gives you upside exposure to ETH, and you can go like leverage 1 to like 1,000 times depending on what the platform is you're using. The downside is like the liquidation threshold on a 1,000 times leverage position is literally like 2%. Like a 2% swing in the price movement will liquidate your principal and subject to like all loss. Okay, so when your leverage long position is liquidated, what does that actually mean? Okay, so let's play it out. The price of ETH, you think is gonna go up, so you go 1,000 times leverage long on it. Okay, the price goes down. The price goes down, and you have a margin call, and your position is liquidated. It's liquidated by a market sell. That's the opposite of what the leverage long position is. A market sell means that you're selling the crypto assets you bought, but now at a lower price, right? Because you're selling the assets you bought at a lower price, that causes downward pressure on the asset, which triggers a new wave of liquidations, and the cycle repeats. This is a long squeeze, okay? Now, what you're probably more familiar with from like the GME era is like a short liquidation or short squeeze. All right, this is where you think that the price of an asset like, I don't know, ETH or Bitcoin is going to go down. So you buy a leverage short future contract, right? So what happens in that scenario, the price will go up, meaning you're wrong, and your position is liquidated by a market buy, right? So remember, in like a short position, you don't actually own the crypto or the stock that you're buying. You just borrow it from someone, right? But now the challenge is you're out of the money, and you have to pay back the ETH or Bitcoin that you borrowed. So you have to go into the market and buy it, but now it's at a higher price than what you borrowed it for, right? You borrowed it at 1, you have to buy it back at 150. That market buy causes upward pressure, which triggers a new wave of liquidation, and the cycle repeats. This is it's a popular narrative for sure, and there's certainly some truth to it. And I even put an example of how this happened in 2023 February with Optimism. I'm going to pull up my tweet here. And what you can see is Optimism's been on a rips, to my surprise, in 2023. On February 2, 23, it was up 45% in the past 24 hours. And I'm going to pull up the chart. And you can see I have 4 arrows on the screen, right? If you look at the far most on the right-hand side, when OP moved from 290 to 310, that liquidated about 2,000 short positions, right? That's the short squeeze part. When OP dropped from 230 to 210, that liquidated about 25,000 long positions, right? And this is all in the matter of 24 hours. So both sides got wrecked on this trade. So that is what happens. That is what happens in a leveraged position. And the thesis behind those who are saying this time it's different is that the open interest, which is the aggregate dollar value of all outstanding futures contracts, I'm looking at ETH specifically, is at is at a 1-year low, right? You can see that open interest on 11/21 is 13 billion, and on 1/23 it's 6 billion. So like, crypto bulls, ETH bulls are saying, hey, look, there's no leverage in the market now. It all got wiped out from FTX, from Terra Luna, and here's, they doubled this on to make it a little more compelling, is the I call it the this time it's different camp. They also look at the percentage of total assets that are in stable coins versus like actual like protocol tokens, utility tokens, right? And what we can see, I pulled this from Nansen Pro. It's called Smart Money Stablecoin versus altcoins, and we can see by February 9, 2023, about 27% of all holdings are in stablecoins. This is USDC, USDT, and the like. But you compare that to Jan to July. No, when was the bull run? July, August 2021. Stablecoin utilization dropped from 30% to 10%. So individuals saying, hey, look, during the last DeFi cycle, there was a ton of leverage, $13 billion of open interest. There was only 10% of the aggregate holdings in stablecoins. But now, fast forward to February 2023, 27% of the total holdings are in stablecoins, and there's less than half of the open interest from the last bull cycle, only $6 billion, right? You put all that together, and that is reason number 2 on why people think that this time it's different. The DeFi ecosystem has been deleveraged, right? Less open interest, more stablecoin holdings. Again, you have to ask yourself objectively, like, this is a convenient explanation, but is the reduction in open interest combined with this dry powder that's sitting in the sideline really a bottom signal, or is it just another narrative that individuals are using to justify investor sentiment? Okay, now we move on to number 3. Topic 3. Why are crypto prices going up? This is the third reason that many people use to justify the current price action within the crypto ecosystem for January 2023, right? And it's called reduced volatility. And what they're actually looking at is the implied volatility of assets like Bitcoin and Ethereum. I'm going to show you Bitcoin first and Ethereum, then I'll walk through an example. So if you look at this is just for one exchange, Deribit. I pulled it up from glassnode.com. It looks at the implied volatility of Bitcoin from March 2021 to now. Okay, and Bitcoin implied volatility has always been kind of high. I mean, I think even as it is today, it's pretty wild, and I'll go into an example. But implied volatility in May 2021 was about 150%. It averaged between like 75 and 150, and then it dropped and went back up to, I don't know, 125, 140 in May, June, July 2022, and then now it dropped to like record low of, I don't know, 30% in February 2023. So implied volatility for Bitcoin has dropped from 130% to 30%, right? And a similar story with Ethereum is implied volatility for ETH the asset is at about 62% on February 7th, 2023, compared to like 220% May 2021. So, okay, implied volatility, assets are less volatile, right? Okay, I guess that's good, but like, what does that mean? Like, how is a less volatile asset, as measured by implied volatility, conducive to growth in the broader crypto ecosystem? Like, when someone says to you, the reason crypto prices are going up is because the asset is more stable. implied volatility is lower, right? You should take the super contrarian point of view and say, how, why, what do you mean? Explain it to me, right? Here's how it works. Implied volatility, and you should do this, you should ask them, because if they don't know to answer this, then you know they're just making it up and just regurgitating whatever the hell they heard on crypto Twitter, right? So let's walk through like what IV is and go through an example. Implied volatility, IV for short, is expressed as a percentage of the crypto price or asset, and it is the predicted one standard deviation move over a 1 year period. Okay, so very briefly, if you didn't pay attention in stats, that's okay. What implied volatility does, it predicts Ethereum's price within one standard deviation of its current spot price 68% of the time in the upcoming 12 months, right? That's part one. And then you have 2 standard deviations is 95% and 3 standard deviations is 99%. So let's look at an example, right? So ETH is around $1,500 right now. It has an implied volatility of 60%. Okay? And if we focus on 1 standard deviation of movement, what that tells us is the consensus in the marketplace is that there is a 68% chance that the price of Ethereum will be between $930 and $2,430 within the next 365 days, right? And you can do the math behind this. You can when you do the math, you'll see that 1 standard deviation to the left is what, 34%, and that's between 930 and 1,500, and then 34% is between 1,500 and 2,400, right? You could take this and expand it by definition. This also means that there's only a 32% chance that ETH will be outside of this range, right? So on the lower end of the bell curve, there's a 16% chance that ETH will be below $930 12 months from now, and there's a 16% chance that ETH will be above $2,430 from now, right? So if you're a technical analyst, you would say, knowing the probability of an underlying asset within a certain price range is an important indicator when you're trying to determine what options to buy and or sell, right? It creates a stability in that, okay, I'm going to buy an out of the money option. Ethereum's trading 1,500 today. I'm going to buy an out of the money option that I'm bullish on to maybe $2,000. I'm willing to pay the premium on that because I believe that the implied volatility as it stands today gives me at least a 34% chance that ETH will be above 1,500 within the next 365 days, and I can capture that by the appreciation of the premium of the option, or the option can actually be in the money when it's greater than $2,000, and then I can sell that, or I can buy the actual underlying asset, right? Conversely, you can go short on it in the same manner. So that's ETH at 60%. Now, if you do this math and you play it out, on May 2021, the implied volatility on ETH was 220%. So that means, and also the spot price was $4,100. So this means that, again, same math, 1 standard deviation, the market believes with the 68% confidence that ETH will trade between an upper bound of 13,000 and a lower bound of negative 4,900, right? So what good is that? Okay, ETH is going to be somewhere between $0 and $13,000 with the 68% confidence, with a 68% degree of confidence in the next 265 days. Nobody can use that for any like long-term price movement. I mean, maybe you could like buy very short, like 1-day expiry options, if you were to buy like dated options, or you could buy like highly leveraged long and or short positions because the implied volatility might justify it, but it's not good for long-term price action. So because because the volatility of ETH asset is lower, people can, technical analysts can look at this and say, hey, ETH has more price stability than it did 1 year ago, which is better for the asset when trying to exercise long and or short options. Now, technical analysts will work with technical chartists to formulate the fourth and final point of view as to why Ethereum prices have been going up in 2023, right? And it's generally called a lower cost basis, and it's an extension of golden crossovers, okay? And it's really like Nostradamus in like the way they do this, dude. So the way it works out is like technical analysts say, hey, lower volatility equals greater predictability of the asset's future price range. This is like Ethereum, or it could be Bitcoin, right? Then they overlay with a series of crossover and oscillator metrics to like quantify potential bottoms. So we're going to go through a couple. Number one is like the Mayer multiple, and this is where you take the 200-day moving average of Ethereum, and then you divide it by its current spot price. And then if that result is less than 0.08, it's a buy signal, and if the result is greater than 2.4, it's a sell signal. That's an oscillator metric. Let's see if I can pull this up, actually. That way you guys can see what I'm talking about. I might... Yeah, I'm looking... Okay, for those listening, I pulled up Glassnode Studio that has the Mayer multiple. So you can see x-axis is time, y-axis is value, spot price of ETH. But at the bottom, you see a green line and a red line, right? The Mayer multiple represents overbought conditions at greater than 2.4, which was May 2021. All right, good timing. And then oversold conditions, as the value was less than 0.08, 0.8 in July 2022. So look at the price action. ETH price, when ETH price on May 2021 was $3,000. Mayer multiple indicated an overbought condition. So at this point, if you were a chartist, you would have dumped your position. Yeah, that's retrospective though. And then Mayer multiple indicated an oversold position when ETH was at around 1,000 in July 2022, right? So it's an oscillator because it represents an upper and lower bound. And this chart is free on Glassnode if you want to check it out. So chartists will use that in addition to like what I call golden crossover metrics. Golden crossover metrics are where you take like the moving averages of a short-term and long-term metric, like 50-day daily moving average, 100-day daily moving average, 100-day daily moving average, 200-day daily moving average. If like the shorter one is greater than the longer one, that represents a buy signal. And you can even extend it by taking the spot price and then comparing that against the 50, 100, 200-day daily moving average to indicate potential buy signals. I put this in here because Bitcoin Magazine Pro loves using, it's a great magazine, I read them all the time, and they are like all about daily moving averages, and I thought it'd be interesting to point out. And you can see I pulled up a chart that has, we'll look at the bottom right one. It's Bitcoin price above 100-day daily moving average. So this one compares the spot price of Bitcoin on 2/3/2023 versus the 100-day daily moving average. And you can see the spot price is 19,000. The 100-day daily moving average is 17,000. Since the spot price is greater than the 100-day daily moving average, this is an indicator of a buy signal, right? So technical analysts, technical chartists will look at like the daily moving averages, these oscillator metrics with the Mayer multiple. They'll look at the implied volatility, and they'll try to put this all together and say, Now we have a composition of metrics that represents buy signals, right? There's one more that people like technical analysts like to use, and I'm bringing all of this up because to show how kind of crazy this gets, and I think there's a much easier way to do this. Is another metric. It's called the realized price index. Realized price index takes the purchase value of Bitcoin or Ethereum in a time window and divides it by the number of Bitcoin or ETH tokens in that circulation. That gives you an average cost basis. If the average cost basis is less than the spot price, that means people are profitable, and it's a bullish signal. So I'm loading up the realized price chart for Bitcoin. It also exists for Ethereum, where you can see x-axis is time, y-axis is price. The realized price on Feb 3, 2023 is 19,000. The spot price is 22,000. This means that at this point in time, the average at this point in time, the cohorts of buyers within Bitcoin, these are the short-term holders, the long-term holders, and the new holders, are all in the aggregate profitable. They've all bought Bitcoin on average for $19,000, and the spot price right now is $23,000. That is a profitable trade. So people use like a ton of analytics tools to get this on-chain data alpha, and I actually put together a table for free that you can like see that says, hey, what are all the technical indicators for Bitcoin across the Mayer multiple, the 50-day daily moving average, the 100-day daily moving average, the 200-day daily moving average, as well as the realized price? Like, what does it all tell you? And it says, of course, all the signals point to bull. Mayer multiples bullish, 50s bullish, 100s bullish, 200s bullish. Realized price was neutral to bullish, and I put neutral just to be conservative. But does this mean anything? Like, these metrics, does it actually signify? Does it explain why these why crypto assets like Bitcoin and Ethereum have seen such a depreciation over the past 30 days, right? People are spending a lot of money to get this type of alpha, right? Is that why? So here's my point of view. If you go to like Substack, go to crypto Twitter, go to Reddit, you're going to see that all of the crypto experts point to implied volatility, macroeconomic headwinds, lower cost basis, golden crossover. They point to all of this as buy signals. Buy. Now's the time to buy, right? And you can go on because I was playing around with this. Token Terminal, which I use for financial metrics, they have 17 financial metrics across like 30 crypto assets. Glassnode, which we use to get the Mayer multiple, has an on-chain metrics catalog of over 200 KPIs. And Coinmetrics has the Glassnode catalog, but for 3,000 crypto assets. All right. There's enough on-chain like alpha. There's enough on-chain analysis to like reaffirm whatever narrative du jour or of whatever asset or social media influencer that you follow. I mean, there's so much information with respect to KPIs and on-chain metrics catalogs that it becomes, I don't know, I think too much, right? But if you persisted and you said, wow, all of these on-chain indicators, these influencers, they're right. They're right. All the technical indicators, now's the time to buy, right? You listen to them. And if you listen to them on like January 2nd, you would actually see a buy now theme. I've pulled up a chart that has the year-to-date performance of ETH, BTC, Sol, LDO, and Optimism. All are up through January 31st, 2023. And what you'll see, all are up and to the right. Optimism's up 223%, right? LDO's up 89%, Solana's up 50%, ETH's up 40%, BTC's up 37%, S&P's up 6%, right? So if you're like a retail trader, you see this and it's the end of January, you're like, oh gosh, what, I don't want to miss this, right? Now is the time. Everybody's saying so. This rally is different. We have reached the bottom. Crypto assets will never be this cheap in our lifetime. I missed the last bull run. I won't miss this one, right? You've heard all of the excuses. So on 129, on 130, like these poor retail traders, they ape in and boom, what happens? 11 days after the hype related to this time it's different. There's a new set of fundamentals. Jerome Powell is going to ease the quantitative tightening that's pushing up risk-free asset prices and pushing down risk-on asset prices, right? All of like the talk tracks that you've heard on 129, 130, 131 that point to a bullish signal. If you bought crypto on 131 and you held it to now 212, you'll see that these assets that were up 20 to 50% are now down 10 to 20%, right? Yeah, S&P is down 1%, but Optimism's down 20%, Solana's down 20%, ETH's down 10%, Bitcoin's down 7%. It goes on and on, right? So, I mean, I feel bad for the retail trader because they see all of these articles and YouTubers talking about now this time's different. They ape in on like the absolute peak. And what happens? They're down 1 to 20%. Retail traders who listen to the herd, bought into the technical analysis, all of the oscillators, the moving averages, the volatility narratives, the Fed soft landing, at the highest point in time when the herd was the loudest was exactly the wrong time to buy, right? So that leads me to my next point. Are technical indicators useless, right? I came from traditional finance, and yeah, they would say no, right? They would say no. I mean, the challenge is not that technical indicators are useless. I don't think they are useless, but they're retrospective, right? They it's a quantification of past performance in an attempt to predict future outcomes. And what I mean by that is you can look at like what good is the 50-day daily moving average crossing over the 200-day daily moving average on 130 if we're looking at price action on 1-2 trying to predict what to do next, right? Daily moving average are all retrospective and reflect the price movement of an asset after it's happened, right? It's an average of historical performance. Implied volatility, I mean, okay, it's cool that I can say with 68% confidence that Ethereum is going to be somewhere between 900 and 2400, but like that doesn't fill me with confidence in really the absolute direction of the asset, right? Same with like the open interest. A 50% reduction in open interest sounds nice, but like there's still $6 billion of open interest. This is leverage in the futures market. And even if you account for like the increased supply of capital deployed to stablecoins, the stablecoin capital allocation just runs like the inverse of ETH price action. It doesn't really mean anything. All it says is that ETH prices go up, stablecoin holdings go down. ETH prices go down, stablecoin holdings go up. That's all it means. That's all it means, right? And even if you were to believe all of these indicators are true, like I generally agree that they do reflect the reality of the market. What these indicators and oscillators and like technical analyses don't account for is I call it the depth and duration. Oscillators and indicators and charts can like predict the direction of a chart, but it can't tell you. It can predict the direction of an asset. It can say like Bitcoin's going up, Ethereum's going up, Dogecoin's going up, etc. But what it doesn't tell you is how high Bitcoin goes or how high Ethereum goes, right? And that is the problem when you're dealing with out of the money options or like leverage futures contracts, right? I call this depth because ultimately what you're trying to figure out is how high or low will the target asset appreciate relative to your like your target, right? So cool, 50-day moving average crossing above the 200-day moving average. This Mayer multiple, like being in a buy signal, great, cool, buy it. But how high will Bitcoin or Ethereum go based on that signal? It doesn't tell you that. The signals don't tell you the depth, nor do they tell you the duration. And this is why options are such a bad play for most traders. You could be right about the direction of a trade. You can say, I predict Ethereum's going to go up. And then you could be right that Ethereum's going to go up. But what you don't know is when Ethereum's going to go up. Is Ethereum going to go up next week? Is it going to go up next month? Is it going to go down for 10% in the next 30 days, then up 80% in the next, next 200? This is called duration. And how long will that price action last before the asset reverts to its mean? Reversion to mean is a known, measurable, and like widely accepted like theme in that whatever asset you're buying, these extreme misalignment of pricing on the bull and bear side ultimately converge to a reversion to the mean, right? And you can see this with the S&P 500. You can see this with the P ratio. You can see this with the overall crypto. You can pick any crypto asset. They all revert to the mean, right? And this is a problem with duration. You say, okay, I think crypto's going to go, I think Bitcoin's going to go up to 10,000, but you don't know when it's going to go up. And you don't know how long it will be at 10,000 before it goes back down. This is why if you're going to trade options, I wouldn't trade options, but if you're going to trade options, it's important that you don't only have a point of view on the direction of the asset, but you also have a point of view on how long the asset will appreciate before reverting to the mean and what the depth of the appreciation will be, whether it's going to go up 5%, 10%, or 20%, right? So you put all this together, and ultimately, like, I've concluded that what's causing crypto prices to go up, it's really none of the stuff that I've looked at. I mean, I think the technical analyses and the charts and the oscillators and the moving averages all like are kind of good to know, but it's a result of the price action. It's not what's causing the price action. A 50-day moving average crossing over a 200-day moving average is the outcome of price action, right? What I theorize is what's causing prices to go up. The reason crypto prices is going up is because crypto prices are highly correlated to U.S. equities. And crypto enthusiasts hate saying this, hate acknowledging it, and like I catch a lot of shit for saying it, but it's true, right? And I say this is a crypto enthusiast. I have mined Bitcoin. I have an Ethereum node. I believe Ethereum is going to be the settlement layer for the world's next generation of financial applications. I think Bitcoin is going to be a store of value. I think it has the potential to be the peer-to-peer system for a permissionless network of like payments that have its own like currency. I buy into everything the Bitcoin standard says. I love it. But I also acknowledge that for now, Bitcoin is highly positively correlated to the performance of the S&P 500. And this is not like a hot take that I'm just pulling out of thin air. It's true. If I pull this from the block research, it's Bitcoin's. It's called the Pearson correlation between BTC, Nasdaq 100, the S&P 500, and gold. And let me set this up. What you'll see is that as of February 2023. Bitcoin runs at a 0.91% correlation to the Nasdaq 100 and about like a 0.9 correlation. This is out of 1 to the S&P 500. In fact, for like the past 3 years, Bitcoin has been highly positively correlated to the performance of the equities market. In fact, the only time when Bitcoin became decoupled from the performance of the S&P 500 was during the FTX collapse last year, when it actually did worse than the S&P 500, which is what you see in this chart for for November. I hate to break it to everybody who's a crypto enthusiast, but like this is the reality, right? The crypto narrative of Bitcoin as a hedge against fiat currency debasement, I mean, this is straight out of the Bitcoin standard, has been proven to be wrong, at least for now. And again, this is for now. I don't think it'll be this way forever, but if you're going to buy crypto assets, you got to know the correlation between the broader US equities market, because their crypto assets like Bitcoin are really just treated as a high beta tech stock, right? And that's what I mean. I'm not saying that rising equity prices are causing crypto prices like Bitcoin to go up. I'm saying that crypto assets like Bitcoin behave like a high beta tech stock. High beta tech stocks have a high volatility, usually measured as over 1, and as such have a high correlation to the market. So when for example, I think like Tesla is a high beta tech stock, right? So when the market goes up, Tesla goes really up. But when the market goes down, Tesla goes really down. It's the same way with Bitcoin. That's why when you saw Bitcoin go up 30% in 2023, the S&P 500 went up 37% in 2023, right? That's the truth. And here's the data. I pulled the correlation matrix from what's this sort? Crypto Watch. You guys should definitely check this out. It shows the correlation between Bitcoin, Ethereum, Optimism, Lido, and Sol. And you can see all values above 0 are highly correlated, but Bitcoin to ETH is the highest correlation. So remember, Bitcoin has a 0.9 correlation out of 1 to price movement of the S&P 500. Ethereum has a 0.9 correlation to Bitcoin, right? Solana has a 0.73 correlation to Bitcoin. Moreover, the confidence interval or the confidence level for the correlation is 95%. So we're saying that we're 95% confident that the price action of Ethereum is highly correlated with the price action of Bitcoin, which is highly correlated with the price action of the S&P 500, right? And again, what I'm saying is that the data suggests that the market performance of ETH, Sol, Lido, Optimism has a strong positive correlation to the market performance of Bitcoin, right? In fact, this pissed off a lot of ETH people, and I hate to do it to you, but it's true, and I say this as an ETH advocate for all the reasons I've described earlier. I believe that Ethereum's proof of stake migration has had zero impact on the price action of ETH, right? There's been a ton of talk around net issuance reduction, which is true. The elimination of sell pressure, which is true. Credible neutrality, I don't know, Jura's out on that. Perma yield with staking derivatives, okay, I accept that. But all of that led to like price predictions in 2022 of ETH to be $10,000. I mean, this is insane. They were all wrong. Every single person who said that was wrong. And I took the contrarian point of view in 2022 and predicted ETH to be at 1,200. And unfortunately, I was right. And the reason I was right is because ETH, the asset, is highly correlated to Bitcoin, which is highly correlated to the S&P 500. In fact, if you look at this chart I've pulled up, it's the performance of ETH versus the SPY as of 9/15. That's when proof of stake migration happened. And what you can see is light blue is SPY, dark blue is ETH. When the S&P goes up, Ethereum goes up. When the S&P goes down, the Ethereum goes down. And again, the only deviation in this movement was during the FTX crash, when Ethereum performed worse than the broader S&P market, S&P 500. So we put this all together, and we have to accept that Ethereum has the potential to create an open, permissionless, trustless financial ecosystem where the opportunity to participate in market-making activities, acting as a lender, doing all the things that you can't really do in traditional finance, That's going to happen in Ethereum. I believe all that to be true. But at the same time, we must acknowledge that the price of Ethereum and the price of Bitcoin is really a reflection of the overall market sentiment of the US equities, right? And that's just the truth. The correlation's there. So what do we do? Do we just say to hell with this, and do we just abandon this whole crypto experiment and buy S&P 5, buy SPY or QQQ? No, absolutely not. And the reason we don't is because correlation quantifies the relationship in price movement. It does not measure the depth or nominal movement of the asset itself. And what I mean by that is we saw from January 1st to January 2023 a 7% increase in the spot price of SPY, right? But in that same time frame, we saw a 40% increase in Bitcoin, a 37% increase in ETH, an 84% increase in Sol, a 220% increase in Ethereum, right? So these assets are going up at a much more dramatic velocity than the underlying S&P 500 index. Specifically, we can conclude that when U.S. equity prices go up by some Y percentage, highly positively correlated crypto assets like BTC, ETH, etc., will increase proportionally by Y% times an unknown X, right? This is the alpha. I think if you want to get rich in crypto, this is what you got to do. Like pick high, this is what I'm doing. You pick you pick highly correlated crypto assets that are correlated to the S&P 500, and then you just buy them, right? And you realize and you accept that until there's some dramatic departure that decouples the price movement of ETH, Bitcoin, Solana, OP, etc., from the underlying S&P 500, you just got to ride the trade and make money, right? We're all here to get paid. So if US equities go up by Y, crypto assets will go up proportionally by Y times some unknown X, right? And this is playing out exactly as we predicted for BTC, ETH, Solana, Optimism, any crypto asset. And you can see this more. You can see this. I'll pull this chart up again just to like hammer it home. Look what happened when look what happened when the S&P 500 went down on 2/3/23 to 2/11/23, right? I have SPY, ETH, BTC, Solana, LDO, Optimism. SPY goes down 1%, Optimism goes down 20%, Solana goes down 18%, ETH goes down 9%, Bitcoin goes down 7%, right? Why? It's because it's highly correlated to the stock market. Okay? So, why are crypto prices going up? It's because of their high correlation with the broad basket of U.S. equities as measured by the NASDAQ 100 and the S&P 500, right? All these other technical indicators, they're good to know, informational, but like I wouldn't lose any sleep over it, right? So how do you make money off this? Here's the trades. Do your own research, of course. But if you accept what I believe to be true, and you should because the data says so, idea one is I would trade high correlation asset pairs. So maybe you're not like an altruist or a purist in the crypto ecosystem. You don't really care like which layer one's gonna emerge as the winner, nor do you care like if the future of DeFi is a multi-chain world or a monolithic one, or like a chain of chains like Cosmos or like or Ethereum's like layer 2, layer 3, right? You don't care. You just want to get paid in crypto. So I think the path of least resistance would be to buy base layer crypto assets that have the highest positive correlation with BTC and the lowest fully diluted market cap, right? What I mean by that is like you can just buy BTC and hold it. Kathy Woods thinks Bitcoin's going to be 1.5 million by 2030. That's amazing. I hope she is. Be a freaking billionaire. But in the absence of that, you could buy ETH, Solana, even near tokens, right? The challenge is, because the reality is that those tokens are highly correlated to Bitcoin, and Bitcoin's highly correlated to the S&P 500. You just got to realize that this is not a risk-free trade, because if there's some underlying problem with the protocol that with the protocol that corresponds to the token you bought, it's going to have an outsized impact negatively on the performance of the crypto asset. Like, for example, Solana had like 10 blackouts last year. I think if Solana has 10 blackouts this year in 2023, we're going to see negative price action on at the SOL token, even if it's highly correlated with Bitcoin. I'm personally bullish on like Near and Solana, just as a proxy of Ethereum and Bitcoin performance, right? So maybe you buy ETH, put it to Aave, get some collateral out of it, get USDC, use the USDC to buy some Solar Near tokens, right? And then you sit back and wait, right? If you have a day job, that might be the easiest thing to do, right? But idea too is you could also just trade around emerging interests. If you follow like crypto Twitter, crypto Reddit, you'll see like I see four themes emerging in 2023. Number one is liquid staking derivatives. I think this is especially true after the SEC's like latest attack on Kraken. They fined Kraken $30 million, banned Kraken from Kraken's depositors buying staked Ethereum. I think this is going to be a bull thesis for like decentralized liquid staking derivatives like Lido, Rocket Pool, Stakewise, especially on the backdrop of the staking unlock that's going to happen in, I think, Q2 2023, right? So I think it's the Shanghai upgrade, right? So if you're bullish on liquid staking derivatives like Ethereum staking in general, maybe you just you trade around the narrative of liquid staking, right? Because if ETH goes up, the LSD tokens associated with ETH, like Lido, Rocket Pool, Stakewise, will also go up. It's not so much interesting to me, but I know a lot of people are really interested in this. So that's part one. Number two is you could also, and this is like what I'm interested in, is invest in real world assets. So real world assets, these are like, imagine you owned a Bored Ape or a high-end NFT and you want to use it as collateral to finance a single-family rental in Mobile, Alabama. That sounds insane, but it's not because it actually happens now. This is an emerging area of interest. There's a couple of protocols offering this: Clearpool, Centrifuge, Maple Finance Home, Realty, Goldfinch. I think Teller Finance is doing this, USDC Homes. There's an abundance of them, and this didn't exist 12 months ago. So if you are bullish on using on-chain capital to invest in off-chain real-world assets, whether it's an apartment complex in Mobile, Alabama, or a O'Reilly Auto Parts from a Maker Lending Vault, you should invest in real-world assets. And this is an area I'm extremely bullish in because I believe in the use case. And I know there's a high correlation with ETH, which is highly correlated to Bitcoin, which is highly correlated to the S&P 500, right? Moreover, you could also trade layer 2 ecosystems. So I think we can collectively agree that Ethereum will only succeed. Ethereum will only succeed with the adoption of layer 2s, right? Most users have been pushed off of L1. Can't afford it, right? Paying $3, $5, $10, $20 for a transaction. No way for most crypto users post 2020 are going to do that. They've all been pushed to layer 2s like Arbitrum, Optimism, Polygon sidechain, which is going to be a ZK EVM equivalent soon, Loopring, maybe, and ZK Sync when it comes out, right? You could trade layer 2 tokens associated with this. There's some like lockups. I'm personally gonna wait for the RB coin. I think the perpetual derivatives platforms that are on Arbitrum, like GMX, are going to be a differentiator for layer 2s. So I'm personally bullish on Arbitrum when the token launches, as well as Polygon Matic when it converts to a ZK EVM layer 2 and not a sidechain, right? Number 4, you can invest in under-collateralized lending platform. This is super new. It didn't exist 12 months ago. These are platforms where you can it's called efficient use of capital, but you can essentially take out loans where the loan to value is greater than 100%. I wrote an article about this. It's called on how to do this with sentiment. There's also notional. There's a gearbox, right? It's very new, but I think this is going to be the next wave of alpha for 2023. So if you're like for example in Aave, if you provide 1 ETH as collateral, you can only take out like what 0.7 ETH max, and you'll be liquidated when like the health factor is like 1.2, right? So when either the collateral the loan is about 1.2, that's that happens when usually the collateral goes down or the loan value goes up, right? This happens when you're not buying a stable coin. You'll be automatically liquidated, right? So you take 1 ETH and you borrow like, I don't know, 0.5 ETH of USDC, right? Under collateralized lending means you can take 1 ETH and borrow like 5 ETH worth of USDC, right? Loan to value way greater than 100, right? Loan is 1 ETH, value is 6 ETH actually, 6 ETH. So yeah. So if you have the time, if you have the time and energy, I would encourage you to use a platform like Token Terminal that I honestly think Glassnode and Coinmetrics, it's overkill, especially if you're not a professional trader. You can get really sound financial metrics from Token Terminal that you can use to quantify trading volume, daily active users, developers, right? You take all those metrics, you combine it with like the amount of revenue the protocol generates versus the amount of revenue it keeps. It's called retained earnings. You do the math, you use the DeFi protocols, you use the dApps, you believe in it, and you take outsized risks, right? But again, this requires conviction, research, and energy. If you don't have the time to do that, and you just want to appreciate and if you just want to participate in the broader appreciation of crypto in general, it might be easier just for you to buy and hold ETH, BTC, or Solana, or Nair if you're feeling a little spicy, right? But what I implore everyone to do, no matter what, is to reject all crypto narratives. And this sounds really spicy. I would just be super cautious about all crypto narratives on Twitter and Reddit. I mean, all of these narratives, I believe, that attempt to explain why the price of your favorite crypto stock is going up or down. I mean, you've heard it all. Shorts are getting squeezed. Leverage has been wiped out. Ethereum's not deflationary. ETH will be 10,000 next year. Point of sale, proof of stake has limited all sell pressure, right? These are all narratives that attempt to explain the current price action in the market. These are highly qualitative statements that really don't prove anything. The only thing that we know with 100% certainty is that ETH and Bitcoin are highly correlated to the performance of the S&P 500. Everything else, this noise about like proof of stake sell pressure being eliminated, ETH being net inflationary, short squeezes being wiped out, leverage being gone, right? Those are explanations, but that doesn't explain. There's no like data to say to justify that is why the prices are going up. And I encourage everyone to read this book, Irrational Exuberance by Robert Shiller. I read it a long time ago. I read it once a year. That's how good it is, right? It analyzes investor psychology and how humans attempt to rationalize bubbles, peaks, valleys, long-term price asset mismatch, right? This is when the price of Ethereum is X, but should be X plus 100 or X minus 100, and extreme price movement, right? Robert Shiller in Irrational Exuberance explains this through the lens of like herd behavior that is justified by compelling stories at current price levels. The narrative is around this concept called moral anchors. It's the belief that focuses on the vividness, plausibility, the consistency of qualitative factors rather than quantities and probabilities. I mean, if you've heard anything about like the whole Ethereum, like as the decentralized supercomputer of the world, like the whole bankless thing, we're going west, right? Those are really awesome like narratives. right? That focus on beliefs and vividness rather than quantities and probabilities, right? That is, I think, all of crypto Twitter and Reddit. And just exercise extreme caution when embracing a narrative you see on there, right? In fact, I encourage you to take a moment and like look at your Twitter or Reddit feed and like ask yourself, is it a manifestation of the moral anchors tied to a specific belief of your crypto asset? Or is it like hard and fast data? So this is my closing thoughts. If you accept my theory that Bitcoin ETH price action is highly positively correlated to US equities, which you should because the data is clear, there's no way around it, you're probably asking yourself, well, what's causing the price of US equities to go up? That's a fair question. And we did answer it in number one. But I'm going to call this out again. I don't think U.S. equity prices are going up because of market growth and consumer demand. In fact, 82% of the S&P 500 companies who have reported negative earning guidance in Q1 2023. I have a chart that that we can see here. It's S&P 500 change in forward 12 months earnings per share versus change in price 10 years. This is on factset.com. And what you can see is the price action between the S&P 500 share price and the forward 12-month earning per share guidance. And what we can see is that let's look at the actual headline here. For Q1 2023, 58 of the S&P 500 companies have issued negative EPS guidance and 13 have issued positive EPS. That's the 82%. The forward 12-month P ratio for the S&P 500 is 18. This is below the 5-year average, but above the 10-year average, right? So more room to go. So we don't think that the S&P 500, so we don't think that corporate growth is the reason why U.S. equities are going up, which is weird because that should be the only reason U.S. equities are going up, right? It's a function of like consumer spending and how strong the balance sheets are of these companies. What the market is saying is, in a nutshell, the market believes that Jerome Powell, who leads the Federal Reserve for the U.S. Federal Reserve, is going to lead us to a soft landing conducive to a strong U.S. domestic employment market with record low unemployment rates. Plain English, the markets think we're not going into recession. Alfonso Pecatillo from the Macro Compass, you guys should check it out. It's a really great read. Had a very interesting point of view on this. He said that this is with respect to Jerome Powell at the last FOMC meeting. Jerome Powell didn't push back enough, and so markets are now rallying hard in his face. And given Jay Powell's lack of real pushback, markets won't stop unless data comes in very hot, right? So basically, the markets are saying, hey, it's bull season. We don't believe you, Jerome Powell, right? And as a result, that's why we've seen this increase in price action within the S&P 500 and beyond, right? To be fair, Alfonso is forecasting a shallow recession in Q2 2023. But like you can compare this against like other corporate institutions, investment banks like Goldman Sachs, who now is saying they adjusted their recession guidance from 35% to 25%, right? So Goldman Sachs thinks a likelihood of recession is now 25% or less, right? Meanwhile, LPL Research, this is like a technical analysis, independent research advisory firm that I follow, states a recession will happen in 2023, but it'll be shorter than the post-war average because consumers are on better footing with access to hot labor market and large amounts of cash, right? LPL Research goes on to say that after this mild recession is going to be over, once it's over, there's going to be 64 months of expansionary activity. That means 64 months of equity prices going up. So take this all with a grain of salt. The markets think that we're not going to go into a recession. Some economists think that the markets have misplaced growth expectations. Goldman Sachs tends to agree with the markets at this time. Some research institutions think the truth's somewhere in the middle, but they all point to the same net outcome that once the recession's over, whether it's deep or shallow or long and impactful and have high unemployment, once it's all over, we're going to have a super bullish expansionary equities market, which will have a positive implication on crypto prices. Because why? Crypto assets are highly correlated to the performance of the S&P 500. We know that to be true, right? I've written quite a bit about recessions and financial institutions and how I don't trust them and their inability to predict. They just can't predict with any meaningful amount of confidence what the future holds. And I've actually wrote some analysis on this, and I even wrote my prediction of 2023 with respect to the S&P 500. I predicted that the S&P 500 will end at or near 4,000 by 12/31/2023. Right now it's at 4,095, right? You put all that aside, everything I've said about like Jerome Powell, the U.S. Inflationary expectations, recession happening, not happening, technical indicators about like daily moving averages, oscillators, implied volatility. It goes on and on and on. If you put that all aside, I leave you with this. If you want to predict the performance of your favorite crypto token, start by checking its correlation to the broader US equities market. Chances are it behaves like a high beta tech stock. If you do this, it will save you a ton of time and heartache. Buy the highest correlation crypto asset, hold it, maybe do a little bit of leverage, and just wait to reap the benefits. That's all I have, everyone. If you like what you heard, go to frontrunnercrypto.com, hit the subscribe button. I encourage everyone to actually read this analysis, like read it. Don't just listen to this YouTube. I put the link to the analysis in the show note. I think you're gonna get a lot of like alpha. And I'm just generally a proponent of like reading. I think it's a great way to learn and retain information, more so than doing like watching YouTube or even doing audiobooks. I think reading is the path. So make sure you check the show notes. You click the link, you read the article, go to frontrunnercrypto.com. It's free. And if you disagree with me, if you don't think crypto assets are highly correlated to the performance of the S&P 500, tell me why. I'd love to know. Maybe I'm wrong. I'm not meriting any opinion. I will happily change it if your point of view is compelling enough. So until next time, I'm your host, John Cook. Thank you for listening. We're on a journey to front run the next generation of wealth creation, decentralized finance, and crypto. Hit the subscribe button, share with your friends, and subscribe to our newsletter at frontrunnercrypto.com. Remember, don't invest more than you're willing to lose. Until next time, guys. Peace.